Hello students, in today's lecture we'll be discussing about the option trading strategies. Actually from the previous lectures we have been taking this topic option trading strategies, and in today's lecture we'll be taking one of the option strategy, that is the protective put. A protective put is a risk management or risk managing strategy and option strategy that involves holding a long position in the underlying asset like any stock and purchasing a put option with a strike price which is equal to or close to the current price of the underlying asset. That is, when an investor has taken a long position, or we can say he has purchased some stock or some underlying asset, at the same time he buys or purchases a put option to sell those assets if the strike price is equal to or close to the current price of the underlying asset. Such a strategy, obviously this is also a hedging strategy, will be coming in the will be discussed in the upcoming slides, and this is used as by the investor as a protective put strategy. A protective put is a strategy to manage risk, usually using options contracts that investors employ to have protection against the loss of owning a stock or asset. Because when an investor holds an asset and in the future if the prices of that particular asset come down, then in that case he will be suffering a loss. In order to protect himself from that loss, or in order to provide himself a protection cover against that loss, he buys a put option for a fee which is known as a premium. Obviously, when option contracts, you might be knowing, when an investor buys an option contract, whether it is put or call option, he will have to pay a fee which is known as a premium. So this is also a hedging strategy which is used by the investor by buying a put option for a fee or premium. Puts are basically the bearish strategy where the trader believes that the price of the asset will decline in the future. Because bearish trend is that trend in which we expect that price will decline in the future. However, a protective put is typically used when an investor is still bullish on a stock but wishes to hedge against potential losses and uncertainty. For example, he is holding the stock, he is having a fear that the price may come down in the future and he may suffer loss, but at the same time he is little bit bullish also. He is thinking that price may rise in the future also, and in case of price rise he may have earn the profits. So he does not want to lose that profit, but at the same time he wants to make himself protected. That's why he enters into a protective put strategy. Protective put strategy are usually, we can say, used when the investor has taken a long position or purchases shares or other assets that he intends to hold in his portfolio. That is, again, this must be taken into mind that the investor has purchased the stock or shares, or he has taken the long position, and those stocks and shares he wants to hold in his portfolio. Basically, the investor who owns stock has the risk of taking a loss on the investment if the stock price declines below the purchase price. Obviously, if the stock prices in the future go down and fall below the purchase price, then in that case he will be suffering a loss. But by purchasing a put option, he puts a limit on any losses on the stock. It is not necessary that he has to immediately buy the put option. He can buy the put option at any time as long as he is keeping the stock with himself, or he keeps holding the stock. The ideal situation in a protective put is for the stock price to increase significantly, because the investor generally wants that the price should rise in the future and he will be earning profits from his stocks, as the investor would benefit from the long stock position. Because when he has purchased the stocks, or he is going to purchase the stocks for whom he is expecting that the prices would rise in future, and obviously then in that case he will be earning profits. In this case, the put option will expire worthlessly, because if the stock prices have actually increased in the market, then he will forego the option, put option. He won't be using it. It will not be used. It will go useless, or it will go worthless. The investor will have paid the premium, but the stock will have increased in value. Though the investor will have paid the premium, and he has obviously made a payment of premium, and he has suffered a loss of the payment of premium, but at the same time the prices of the stock have increased in the value in the market, so thereby he will be earning profits. Then he will let go this put option. Okay, thank you, students.